Chapter 1: The Retail Trap, the Misconception. Welcome to Episode 1. We are engaging in fundamental analysis, a holistic approach to studying a business. When an investor wishes to allocate capital for the long term, they typically look 3 to 5 years into the future. To execute this effectively, it is critical to separate the daily, short-term noise in stock prices from the underlying business performance. Over the long term, the stock prices of fundamentally strong companies tend to appreciate, thereby creating wealth for investors. To find these companies, the default option for seeking information is the annual report. This is published by the end of the financial year, with all data dated to March 31st. But there is a common pitfall. Many investors open an annual report and immediately skip the opening pages, bypassing the qualitative data entirely. Instead, they look straight at the final pages, hunting for the financial statements to find the net profit on the P&L. They assume this single number defines the historical success and the future trajectory of the firm. Furthermore, they often look at standalone financial statements, completely ignoring the financials of the subsidiaries. This is the trap. The profit and loss statement is an accountant's estimate of the revenues generated and the expenses incurred during a specific period. The P&L is not a direct record of cash moving in and out of the business. It is an accounting representation of revenues and expenses, which means management judgment and accounting policies can materially affect the final profit figure. If you only read the bottom line, you are blind to how that profit was constructed. Chapter 2: The Institutional Mechanics, the Real Concept. To properly read an annual report, you must understand the underlying mechanics and the true perimeter of the firm. Before drawing conclusions from the numbers, spend time with the management statement and the MD&A, or management discussion and analysis. These are perhaps the most important sections in the entire document. The management statement gives you a perspective of how the executive sitting right on top is thinking about his business, revealing the overall management attitude. The MD&A typically discusses macro trends, overall economic activity, global business sentiment for exports, and industry expectations for the year ahead. Once you understand the qualitative narrative, you move to the financials. It is always preferred to look through the consolidated financial statements to better represent the company's financial position, as they include both the parent company and its subsidiaries. There are 3 pillars of financial reporting: the profit and loss statement, the balance sheet, and the statement of cash flows. Today, we examine the P&L, also known as the income statement, statement of operations, or statement of earnings. It shows what has transpired over a time period to answer one question: what earnings did the business generate during the period? It reports the revenue, the expenses, the tax, the depreciation, and the earnings per share. Let us isolate the concept of depreciation, an accounting mechanic that frequently causes confusion. We must separate economic depreciation from accounting depreciation. Economic depreciation reflects the actual physical loss in value of an asset, like a car degrading the more you drive it. This is not what is done in accounting statements. Accounting depreciation is driven by a fundamental rule: the expense of an asset can only be recognized when its revenue is earned from it. Imagine a company buys a factory for 1 billion rupees. If they generate no revenue in the first year, but 200 million rupees of revenue annually for the next 10 years, taking the massive factory cost up front would completely distort the statements. To resolve this, the cost is mechanically spread over the lifetime of the asset. Consider a stockbroking firm. They generate 100,000 rupees from their business, but incur 65,000 rupees to purchase a high-performance computer server with a useful life of 5 years. Instead of showing an upfront expense of 65,000 rupees, they divide 65,000 by 5, resulting in an annual depreciation expense of 13,000 rupees. After this computation, they would show its earnings as 100,000 minus 13,000, equaling 87,000 rupees. Depreciation seamlessly aligns the expense with the revenue generation over time. Although depreciation does not capture the actual cash outflow today, it reflects the fact that productive assets eventually lose their production capacity due to physical wear and tear and need replacement. Chapter 3: The Surgical Audit. How to read it. Now we step into the audit. We will use the FY14 Annual Report of Amara Raja Batteries Limited, or ARBL, as our practical example. You do not just read the aggregate numbers on the P&L. You must dissect the associated notes to gain full clarity. Start at the top line. The first item is the sale of products. For ARBL, the gross sales of products stood at 38,041.27 million rupees for FY14. We then deduct the excise duty paid to the government, which was 4,005.15 million rupees. This leaves us with the net sale of products at 34,036.12 million rupees. We add the sale of services, like annual battery maintenance, bringing in 309.32 million rupees, alongside other operating revenue of 21.15 million rupees. This totals our net revenue from operations at 34,366.59 million rupees. Below this line is an item labeled Other Income, standing at 455.14 million rupees. Digging into Note 18, we see this includes interest on bank deposits, mutual fund dividends, and insurance claims. Adding this brings our total revenue to 34,821.73 million rupees. Next, we move to the expense details to analyze the exact costs required to generate that 34,821.73 million rupees. The largest expense is the cost of materials consumed. For a battery manufacturer, this is raw material, standing at 21,011.95 million rupees. We must also account for purchases of stock in trade at 2,113.69 million rupees, and the changes in inventories, which actually provided a credit of 292.10 million rupees. We then deduct the employee benefits expense at 1,583.16 million rupees, which covers salaries and provident funds. We subtract finance costs of 7.18 million rupees, representing the interest paid to lenders when the entity borrows funds. We subtract our non-cash expense, depreciation and amortization, at 645.71 million rupees. Finally, we find a line item called Other Expenses, sitting at a massive 4,346.60 million rupees. Checking Note 24, this includes manufacturing, selling, and administrative costs, such as advertisement and promotional activities. Adding all these together, the total expenses equal exactly 29,416.19 million rupees. Subtracting our 29,416.19 million rupees in expenses from our 34,821.73 million rupees in total revenues gives us the profit before exceptional items and tax at 5,405.54 million rupees. However, before we finalize this number, we must deduct exceptional items. These are infrequent events not expected to be recurring expenses. ARBL reported 38.84 million rupees here. Deducting this, our true profit before tax is 5,366.70 million rupees. To find the final net profit after tax, we deduct the applicable tax expenses. We deduct the current corporate tax of 1,580 million rupees, plus deferred and earlier year tax provisions, totaling 1,692.34 million rupees. Our bottom line profit for the year is 3,674.36 million rupees. We finish with the EPS, or earnings per share. This is a frequently used statistic indicating how much the company is earning per face value of the ordinary share. ARBL indicates that 170,812,500 shares are outstanding in the market. dividing our 3,674.36 million rupees profit by those shares yields an EPS of 21.51 rupees per share. Chapter 4. The Weaponised Application, Red Flags and Trade-offs. You now possess the foundational mechanics. Let us apply this to identify corporate red flags. First, scrutinize the other income line item. Usually, this forms a very small portion of total income. A large, unexplained spike in other income demands further investigation. If a company is boosting its total revenue by banking large insurance claims or selling off non-processed scrap, it provides zero insulation against a failing core business. It is merely an illusion of operational growth. Second, carefully audit the other expenses line. When a company lumps hundreds of crores into a broad category, you must go to the footnotes. If a firm is masking excessive administrative bloat or failing marketing campaigns under a generalized label, the core operational efficiency may be deteriorating. Third, monitor exceptional items. If a company consistently reports extraordinary, non-recurring expenses year after year, they are no longer exceptional. They might be structural flaws being separated from the standard operating profit to make the core business look healthier than it is. Finally, do not play an amateur's arbitrage with the EPS. The EPS serves to assess the stewardship and management role performed by the company directors. However, because the EPS is derived entirely from the net profit, it inherits every single accounting adjustment we just reviewed. If management delayed recognizing expenses or artificially boosted revenue with one-off exceptional items, that EPS is no longer an accurate reflection of the company's continuous earning capability. You must strip away the noise and reconstruct the statement line by line. Only then can you see the true earning power of the enterprise.